Hello fellow compounders, welcome back. Today we're going to explore investment strategies that have reshaped the landscape of personal finance. We'll dissect 6 of my favorite investment strategies, starting with the legendary Warren Buffett's approach, followed by coffee can investing. Next, we'll do GARP, which is growth at a reasonable price by Peter Lynch. Then we'll do dividend growth investing, high yield dividend investing, and finally, passive index investing. Each strategy will be unpacked with real world examples outlining their benefits and challenges. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor and you're responsible for your own financial decisions. So let's get started. First up is the investment titan, Warren Buffett. His approach revolves around identifying undervalued stocks with enduring qualities. It's not just about buying cheap stocks, it's about finding wonderful businesses priced below their intrinsic value. Buffett's strategy is characterized by thorough research, understanding the ins and outs of the business, and a steadfast commitment to long-term value. He prioritizes businesses with a moat, which means a unique competitive advantage that ensures long-term profitability and market dominance. I did a detailed video about Buffett's investment strategy. Here's the link. Let's take Berkshire's significant stake in Apple as a case study. Berkshire's investment portfolio is worth around $355 billion, out of which Apple is $166 billion, about 47% of the investment portfolio. This investment demonstrates Buffett's ability to adapt his traditional value investing principles to modern tech giants. Apple's strong brand, customer loyalty, and innovative edge attracted Buffett despite his historical reservation towards tech stocks. Let's analyze Apple's stock growth since Berkshire's investment, highlighting the strategic value play at hand. Notice the stock's resilience and growth, in line with Buffett's value investing principles. Since the time Berkshire started buying Apple in 2016, Apple has provided close to a 26.76% compounded annual growth rate. This means that if you had bought $10,000 worth of Apple in 2016, it's now worth around $80,000. The advantage of Buffett's approach includes the potential for substantial long-term growth and investment in fundamentally robust companies. However, it demands deep market knowledge, patience, and the acumen to identify true value, which can be challenging. Buffett's method is ideal for the diligent investor who seeks to understand their investments thoroughly and is comfortable with a long-term horizon. It suits those who are not just chasing market trends, but are focused on the intrinsic value and long-term potential of businesses. Having explored the detailed analytical approach of Warren Buffett, let's transition to a strategy that emphasizes simplicity and long-term commitment, coffee can investing. Now on to our second approach, coffee can investing. The concept was popularized by Robert Kirby in the 1980s, who noted that many investors often make the mistake of selling their best performing stocks too early. The strategy draws its name from the old practice of people putting their valuable possessions in a coffee can to keep them safe for a long time. Originally, this approach was a literal practice of storing physical stock certificates. Kirby's observation highlighted the potential of holding onto stocks for an extended period, allowing investments to grow significantly without the temptation of frequent trading. Central to coffee can investing is the principle of buying and holding stocks over an extended period, often decades. The strategy emphasizes minimal intervention, letting the investments grow over time. It's basically a set it and forget it approach. It starts with meticulous stock selection, focusing on companies with solid fundamentals and the potential to grow significantly. The idea is to pick stocks that one believes could be the 100 baggers. Stocks that could potentially grow to 100 times their original value. A textbook example of a coffee can investment is Johnson & Johnson. Its diversified healthcare products, stable growth, and strong market position make it an ideal candidate for this strategy. If you had bought $1,000 worth of Johnson & Johnson when it IPO'd in 1944, now it would be worth over $10.3 million. While not every stock in a coffee can portfolio will become a 100-bagger, the idea is that holding a broad selection of solid companies increases the chances of some achieving this remarkable growth, compensating for any that underperform. The main advantage is the simplicity and potential for exponential growth through compounding. However, it requires an astute initial selection and immense patience, as the payoff can take many years. It also entails the risk of holding on to underperforming stocks for too long. Coffee can investing suits those who are patient, have a long-term investment horizon, and prefer a hands-off approach. It's ideal for investors who believe in the long-term potential of the market and can resist the urge to react to short-term market volatilities. Coffee can investing stands out for its simplicity and potential for significant long-term gains. It's a testament to the power of patience in investing and the remarkable results it can yield. To learn more about coffee can investing, here's a link to a more detailed video. Would you be interested in adopting the coffee can approach for your portfolio? What stocks do you think could be the next 100 baggers? Share your thoughts in the comment section below. Now, on to our third investment approach. Let's delve into the growth at a reasonable price strategy, or GARP, popularized by Peter Lynch, the legendary Fidelity Magellan fund manager. This approach combines elements of growth and value investing to find companies that offer the best of both worlds. Peter Lynch believed in investing in growing companies but insisted on not overpaying for their growth potential. He strived for a balanced portfolio that could deliver sustainable returns. GARP focuses on companies exhibiting solid growth prospects but whose stock prices don't reflect overvaluation. It's about finding the equilibrium where stock's growth prospects justify its price. Central to this strategy is Lynch's innovative PEG ratio, the price earnings to growth ratio. It measures a stock's price to earnings (PE) ratio against its earnings growth rate. Essentially, a PEG ratio of less than 1 is often considered a sign of an undervalued stock in relation to its growth rate, making it a key tool for GARP investors. I personally would pay up to a PEG of 2, but not any higher. Let's do an example. Alphabet, the parent company of Google, is a prime example of a GARP investment. The company exhibits strong, consistent earnings growth, yet its valuation, when factoring in for this growth, remains reasonable. Google's forward PE is 21.1, and its next year earnings per share growth rate is 16.4, giving it a PEG ratio of 1.3. By applying the PEG ratio to Alphabet, investors can gauge if a stock is priced attractively relative to its growth prospects. This analysis reveals investment opportunities that others might overlook, focusing solely on either growth or value metrics. I think that paying a PEG ratio of 1.3 for Google is quite reasonable for a company of this quality. The advantages of using GARP include the potential for robust returns by capturing growth at sensible prices and reduced risk compared to the pure growth strategies. The drawbacks are the complexity in accurately estimating a company's growth prospects and the need for ongoing revaluation as market conditions change. GARP is ideal for investors who are comfortable with a moderate level of active portfolio management and possess a solid understanding of financial analysis. It's well suited for those seeking a balanced investment approach, combining the appreciation potential of growth stocks with the relatively safety of value investing. Peter Lynch's GARP strategy offers a nuanced path to investing, balancing growth potential with value principles. By using tools like PEG ratio, GARP investors can identify stocks that are poised for growth but are not overpriced. Do you use the PEG ratio in your investment analysis? What are your thoughts on the GARP strategy? Share your experiences in the comments below. Unfortunately, we've run out of time. We'll continue the next 3 strategies: dividend growth investing, high yield dividend investing, and passive index investing in our next video. So hit that subscribe button so you don't miss it. Thanks for watching, and remember to always be compounding. See you in the next video. Take care.